While most people in crypto are staring at price charts all day, the real story is happening somewhere else. It's happening behind the scenes, deep inside the XRP ledger itself. And what is happening right now is something most retail investors completely miss. Over $1.14 billion worth of XRP has quietly disappeared from public exchanges. Not sold, not dumped, simply removed. And when that much supply vanishes, markets don't stay calm for long. Welcome back to We Are Cosmic. If you're new here, this channel is where we break down crypto and finance from a smart money perspective. Not hype, not fear, and not headlines. We focus on data, liquidity, and what the big players are actually doing. Because price always follows liquidity. If that sounds valuable to you, make sure you're subscribed. Now let me ask you something important. If XRP is sitting around $2, looking calm and stable, why are hundreds of millions of tokens being pulled off exchanges right now? Normally, when an asset reaches a psychological price like $2, people rush to sell. Traders take profits, supply increases, but that is not what we are seeing here. We are seeing the exact opposite. Since the very start of 2026, more than 570 million XRP has been moved from exchanges into private wallets. That means these coins are no longer available for easy buying and selling. They are being locked away. And this isn't random behavior. This is organized, deliberate accumulation. Here's why that matters. Exchanges are where price discovery happens. When supply on exchanges drops while demand stays the same or increases, the market becomes fragile. Even a small increase in buying pressure can push price up very fast. Right now, XRP is holding its price floor while exchange reserves are collapsing. That divergence is a classic early signal of a supply squeeze. What makes this situation even more interesting is who is doing the buying. This is not just retail traders chasing a quick pump. The data shows large wallets, institutional-sized players, are pulling XRP into cold storage. That tells us these buyers are not looking for a short-term trade. They are positioning for something much bigger. Think about it this way. Every XRP that leaves an exchange is one less XRP available for panic selling, short selling, or flash crash liquidity. The sell side of the market is slowly being dismantled, and when selling pressure disappears, price doesn't fall. It compresses like a spring being loaded with energy. This is why the $2 level feels so strong. Normally, resistance levels break down under selling pressure, but here, selling pressure is being removed from the system entirely. And the people buying XRP right now are not afraid of missing a local top. They are afraid of not owning enough XRP when liquidity finally dries up. That tells us something very important about market psychology in 2026. XRP is no longer being treated as a speculative gamble. It is being treated as a strategic asset, a long-term position, a piece of future financial infrastructure. And this is only the beginning of the story. To truly understand what is happening with XRP right now, we need to stop thinking in terms of price and start thinking in terms of flow. Price is just the result. Flow is the cause. And the flow we are seeing in early 2026 is unlike anything XRP has experienced in years. Over the last 3 weeks alone, more than 570 million XRP has moved off centralized exchanges. That is not a trickle. That is a drain. When assets leave exchanges at this speed, it tells us one clear thing. Buyers are not preparing to sell. They are preparing to hold. And holding changes the entire structure of the market. Let's make this simple. Exchanges are like reservoirs. As long as they are full, price can move up and down smoothly. Buyers come in, sellers step up, and trades happen easily. But when that reservoir starts drying up, every new buyer has to compete for fewer available tokens. That is when price becomes unstable, not downward, but upward. What makes this moment unique is the speed of the drain. According to on-chain data providers like Santiment, this is one of the fastest exchange outflows XRP has seen in nearly a decade. In fact, when we compare the first 3 weeks of January across the last 5 years, 2026 stands out as a massive outlier. The volume of XRP leaving exchanges has tripled compared to any previous period. This tells us something critical. This is not just a few whales moving funds around. This is large-scale capital repositioning. Over $1 billion worth of XRP has been removed from the tradable supply in less than 20 days. That kind of movement does not happen without conviction. Now let's talk about where this XRP is going. The majority of these tokens are moving from exchange hot wallets directly into cold storage. Cold storage means offline wallets, long-term custody, and no intention to trade in the short term. Once XRP enters cold storage, it effectively disappears from the active market. Think about the implications. If demand increases while liquid supply decreases, price does not need hype to move higher. It moves because there is simply nothing left to sell. This is why the current price stability is misleading. What looks like calm is actually pressure building under the surface. Another key metric confirms this. The exchange inflow versus outflow ratio currently sits around 4-to-1. That means for every 1 XRP deposited onto an exchange, 4 XRP are being withdrawn. That imbalance is massive. It shows that accumulation is overwhelming distribution. This creates what analysts call a supply sink. Coins enter long-term storage faster than they can return to the market. As a result, exchange balances on platforms like Binance, Coinbase, and Bybit are thinning rapidly. And when exchange inventories get low, even moderate buy orders can cause sharp price jumps. What's even more interesting is that this behavior is not slowing down. The momentum of withdrawals is accelerating. That suggests confidence is increasing, not fading. People are not afraid of volatility. They are afraid of not owning XRP when liquidity finally hits a breaking point. This also signals a broader shift in mindset. After years of exchange collapses, frozen withdrawals, and counterparty risk, investors are losing faith in leaving assets on centralized platforms. Self-custody is becoming the default choice, especially for large holders. And here's the key takeaway for you. When assets leave exchanges at this scale, price becomes less responsive to fear and more responsive to scarcity. Flash crashes become harder, short selling becomes riskier, and upward moves become sharper and faster. Here's where the story of XRP in 2026 gets truly fascinating. Up to this point, we've discussed the massive outflow from exchanges and the supply drain that is quietly reshaping the market. But now we need to look at who is behind the buying, because the answer explains why this market behaves differently from anything we've seen before. Normally, market cycles are driven by one side dominating. Whales buy while retail sells, or retail buys while whales take profits. But in early 2026, something unusual is happening. Both the smart money and the street money are moving in the same direction at the same time. Large wallets holding millions of XRP and smaller retail wallets under 10,000 XRP are simultaneously accumulating. This is rare and extremely powerful. Why does that matter? When both large and small holders are buying, it creates a supply vacuum. Imagine a seesaw where both sides are pushing down on the same end. Nothing is left to counterbalance. In XRP's case, the counterbalance is sell orders. When selling dries up across the board, price doesn't just remain stable, it becomes highly sensitive to new demand. Even relatively small orders can push the price significantly higher because there aren't enough sellers to absorb them. Data shows that both wallet groups have increased their holdings by over 15% since January 1st. That's not a small blip. That's a coordinated accumulation signal, a dual green light for market momentum. And it tells us something critical. This is not a temporary frenzy or FOMO-driven hype. It's strategic positioning across the entire market spectrum. Let's break it down further. Large holders, or whales, are taking positions for the long term. They are moving XRP into cold storage or institutional custody accounts, meaning it's effectively removed from the market. Meanwhile, retail investors are learning from the market's behavior. They are holding their bags like the whales, diamond hands, refusing to sell at minor pullbacks. This is alignment on a level we rarely see in crypto. What does this alignment do to liquidity? It solidifies the market. The available XRP on exchanges drops even further. The float, the number of tokens actively available to trade, is shrinking fast. And as it shrinks, the potential for rapid price spikes increases. In other words, the stage is being set for a supply-driven rally that could surprise anyone still watching from the sidelines. There's also a behavioral lesson here. When both ends of the holder spectrum act in the same way, the usual patterns of fear and greed are temporarily overridden. Retail investors are no longer the predictable liquidity for whales to exit against. Instead, the market is collectively holding, creating a wall of resistance against sell pressure. The usual dynamics that cause dips and corrections are temporarily suspended. Another way to understand this is to think about it in terms of scarcity. Every token removed from exchange wallets is one less available for trading. As more XRP enters long-term storage, the market becomes structurally undersupplied. Even a small increase in demand, a few large trades, ETF inflows, or institutional purchases could create a cascading effect where the price shoots up because there is simply not enough supply to meet it. And here's the kicker. This dual accumulation is happening before the wider market even fully recognizes it. That means institutions are effectively front-running the supply squeeze. They are positioning themselves in advance while retail investors who aren't watching the data are still on the sidelines. By the time the market reacts publicly, a significant portion of XRP will already be locked away, leaving latecomers scrambling. The takeaway is clear. XRP in early 2026 is no longer just a speculative asset. It is entering a structural phase shift. Supply is being consolidated, demand is coordinated, and liquidity is shrinking. This combination of factors sets the stage for potentially explosive moves in the weeks and months ahead. Now that we understand the dual accumulation by retail and whales, it's time to examine the real powerhouse behind this market shift, institutional capital. Early 2026 is shaping up to be a turning point because these big players aren't just trading XRP for short-term gains. They are buying to hold, control, and integrate XRP into broader financial systems. This is the next level of crypto evolution. Since the start of the year, more than $1.3 billion has flowed into XRP spot ETFs and other institutional-grade products. These are not casual investments. These are highly regulated funds designed for long-term positions. The capital that enters these funds doesn't panic sell during minor price dips. It is sticky money, the kind of money that sits tight and reshapes markets without visible drama. Here's why this is crucial. When institutions absorb XRP into ETFs or corporate balance sheets, the tokens effectively disappear from daily market circulation. They are no longer available for retail traders to buy, nor for short sellers to borrow. Each token locked in an institutional account strengthens the scarcity effect we discussed earlier, amplifying the supply squeeze. What makes XRP unique in this phase is its utility beyond speculation. Banks, payment providers, and financial institutions are actively integrating Ripple's infrastructure. XRP is being used as a bridge currency to move value across borders instantly. But they aren't just using XRP, they are holding it to ensure future liquidity for operations. Every large transaction requires a reserve of XRP, creating a continuous demand cycle while further reducing the liquid supply. The speed of this transition is remarkable. While retail traders may still be reacting to headlines, institutions are quietly positioning XRP as a cornerstone of global finance infrastructure. These are players who understand the ledger, liquidity, and settlement mechanics better than most. By securing XRP now, they ensure they control the supply when adoption and real-world usage accelerates. The market isn't just bullish because of speculation. It's bullish because structural demand is growing. Think about the impact on exchange liquidity. With both retail and whales holding and institutions absorbing massive quantities for custody, the float on major exchanges is dangerously low. Even moderate buying pressure can cause sharp price spikes. This isn't hypothetical. Historical data shows that when exchange reserves approach multi-year lows, markets enter what is known as a liquidity crisis. In these conditions, the price reacts violently to relatively small trades, and this is exactly what's happening now. Exchange balances are reaching 8-year lows, below levels we saw during XRP's previous major bull cycles. The remaining XRP on exchanges is becoming highly precious. Every purchase becomes harder, and each new buyer competes for fewer coins. The math is simple. Less supply plus steady or rising demand equals higher prices. We can also see this through on-chain activity. Settlement volumes on the XRP ledger have hit all-time highs, while exchange trading remains relatively flat. That tells us something important. XRP is being actively used for its intended purpose, not just traded for speculation. Banks are moving value, and every transaction creates micro-demand that accumulates on top of the scarcity-driven price effect. Here's the takeaway for investors. This isn't a traditional pump. It's a market evolution. Supply is being absorbed strategically, both by individuals and institutions, creating a structural shift that supports higher prices over the long term. The $2 level is no longer just a psychological barrier. It's the floor under a new institutional accumulation regime. Finally, this sets the stage for the next critical phase. Once exchanges are drained, and institutional holdings dominate, XRP enters true price discovery mode. At that point, the market is no longer guided by sentiment, hype, or fear. It's guided by scarcity, utility, and structural positioning. This is the kind of environment where breakout moves happen suddenly, and waiting on the sidelines can leave investors scrambling to catch up. Now we arrive at the heart of the XRP story in 2026, the supply shock. All the factors we've discussed, exchange outflows, dual accumulation, and institutional demand, combine to create a scenario where liquid XRP is vanishing rapidly. Understanding this is key because liquidity drives price behavior. Without liquidity, even small buy orders can have a massive impact. Let's break it down. Imagine the major exchanges like Binance, Coinbase, and Bybit as reservoirs of XRP. In normal times, these reservoirs are full. Buyers and sellers can trade freely, and price moves gradually based on market sentiment. But in early 2026, these reservoirs are drying at record speed. Over 570 million XRP has been withdrawn in just a few weeks, and the reserves are approaching multi-year lows. This is not a short-term spike, it's a structural change. Here's why this matters. When the supply on exchanges dries up, the market becomes extremely sensitive to new orders. Even a modest buy order can push prices sharply upward because there are not enough sellers to absorb it. This is the textbook definition of a supply-driven rally, and with retail and whales both holding strong, the sell-side resistance is almost entirely removed. The market is effectively a spring that is being compressed, and the tension is building. The numbers confirm the pressure. For every 1 XRP deposited to an exchange, 4 XRP are being withdrawn. That 4:1 ratio highlights the speed and scale of accumulation. The remaining XRP on exchanges is like thin ice. It's all that stands between a quiet market and a sudden price surge. As institutional ETFs absorb more XRP, the supply gap widens further. This is why analysts are calling it a coordinated liquidity vacuum. But there's another layer to consider. Not all XRP leaving exchanges comes from whales or institutions. Active retail wallets are also participating, often in smaller increments, but collectively, their impact is significant. When both ends of the market are aligned, large whales locking up millions and retail holding tens of thousands, the combined effect is exponential. Liquidity is not just shrinking, it is solidifying the market floor. This creates a very important opportunity and risk. For those who understand the mechanics, this is a pre-breakout accumulation phase. But for traders who don't, it's easy to misread the calm $2 price level as stability. In reality, the market is primed for a sharp move once buying pressure increases or news triggers new demand. Exchanges cannot provide enough supply, and the price must adjust upwards. Historical precedent supports this. Previous XRP cycles, like the 2017 bull run, show similar patterns where rapid exchange outflows were followed by explosive price discovery. The difference today is scale and sophistication. Institutional capital is now involved, creating a sticky demand base that did not exist in past cycles. The combination of strategic accumulation, cold storage, and ETF inflows means the upcoming price moves may be sharper and more sustained. This is why understanding liquidity is critical. Price alone is misleading. You can see $2 and think the market is stable, but when the underlying exchange float is evaporating, that price becomes artificial. Every incremental buyer has to compete for fewer tokens, which amplifies upward momentum. This is not speculation, this is market math, and for those who study the data, the next phase of the move is predictable. Finally, it's essential to recognize the broader implications. This supply shock is not just about price, it's about positioning. The big players are locking in XRP for long-term use and settlement, shaping the market before the wider world realizes. By the time the price reacts publicly, most of the liquid supply will already be secured, leaving latecomers scrambling. In other words, the current exchange drain is setting the stage for a rapid and sustained upward phase. We've walked through the massive XRP outflows, dual accumulation by whales and retail, and the institutional absorption that's shaping the market. Now it's time to tie everything together and understand what this means for price, risk, and strategy in 2026. First, let's talk price mechanics. With over 570 million XRP removed from exchanges in just a few weeks, the market is now structurally undersupplied. That means even moderate buy orders can trigger sharp upward moves. Historical patterns combined with Elliott wave projections suggest we are in the heart of a wave 3 move, the most powerful and impulsive phase in a market cycle. This is the stage where scarcity meets momentum. In practical terms, the $2 price level is no longer a ceiling. It is the floor under which price rarely dips, and the next natural targets could range toward $5, $6 according to Fibonacci extensions and liquidity modeling. The logic behind this is simple. Each token withdrawn from exchanges is one less token available to sell. Combine that with synchronized accumulation across retail and whales, and the order book becomes extremely thin. When demand rises, the market reacts disproportionately. That's why analysts are calling this a liquidity-driven supply shock. In other words, the price doesn't move up because of hype. It moves up because there simply isn't enough XRP left to sell at lower prices. But we also need to consider risk factors. Markets rarely move in a straight line. There are legacy wallets, dormant accounts that have held XRP for years, which could suddenly release supply if holders decide $2 is the right exit point. This could temporarily offset some of the scarcity effect and lead to a short-term retracement. Additionally, while institutional demand is strong, no investment is entirely risk-free. Regulatory developments, network changes, or sudden liquidity events could create volatility. Understanding these risks is crucial because being unprepared in a supply-constrained market can result in missed opportunities or sudden losses. This is where strategy comes in. First, monitor liquidity metrics. Exchanges with low XRP balances are sensitive. Even small orders can move the market. Using multiple exchanges ensures you have access to buy or sell if a rapid move occurs. Second, consider the type of holders in the market. Long-term institutional positions are sticky, meaning they won't panic sell. Retail behavior, on the other hand, can be more reactive. By understanding these dynamics, you can anticipate where price moves may accelerate. Another strategic insight comes from on-chain data. Cold storage trends, wallet age, and transaction flow reveal who is holding and for how long. When coins move into long-term storage, the effect is cumulative. The more tokens that leave exchanges, the more extreme the supply shock becomes. This is why timing matters. Entering too late means competing for fewer available tokens at higher prices. Finally, think in terms of market psychology. XRP in 2026 is not just a speculative asset. It is becoming a cornerstone of the new financial ecosystem. Banks, payment providers, and ETFs are locking in tokens to ensure liquidity and operational stability. The market is transitioning from price discovery to scarcity-driven positioning. For investors who understand this, the opportunity lies not in chasing short-term gains, but in anticipating structural moves and positioning before the wider market reacts. To summarize the 2026 XRP thesis, massive exchange outflows are reducing tradable supply. Dual accumulation by whales and retail is solidifying the market floor. Institutional inflows and custody create sticky demand and structural scarcity. Liquidity-driven price mechanics make even moderate buying pressure highly impactful. Legacy wallets and risk factors could cause temporary retracements, but the overall trend favors a significant upward phase. The lesson for investors is clear. Understanding liquidity, supply, and market flow is far more important than simply watching price charts. XRP's journey in 2026 demonstrates that real opportunity comes from studying the ledger, not just the headlines. Those who grasp these fundamentals will be positioned to benefit from one of the most significant structural market shifts in crypto history.